My name is Adrian Blundell-Wignall. I am the Special Advisor to the Secretary-General on Financial Matters in the OECD. I wanted to talk a little bit about the banking reforms proposed by President Obama the other day in terms of capping the size of institutions and limiting the trading of institutions and their exposure to hedge funds and the like. Just let me say that overall the OECD proposed something along these lines to the London summit last year, and therefore needless to say we would welcome these kind of changes, because the whole point about this crisis, the hallmarks of this crisis really were contagion risk and counterparty risk, and that contagion risk really came through instruments such as derivatives and the like to which banks were exposed in various ways, and in particular when they were risking their own capital. Now, when you think about what capital of a bank is for, the capital of a bank is to so that when markets are pricing trades and the like, that capital will be there when it's needed. Now, the problem with betting your principal is that you tend to do quite well in the good years, but when a crisis happens, volatility spikes and liquidity dries up. It's precisely then that a lot of banks start losing their capital on their proprietary positioning. And then, of course, there's less capital available than what the market thought for dealing with the problems. So I think the proposal to take out hedge funds, private equity and the like, and also to limit any part of proprietary positioning which is not in the interests of clients is a fairly good proposal, because it'll take down the exposure to these type of mark-to-market instruments. Now, hedge funds and private equity is quite clear. You should, when you're getting the guarantee of a government guarantees and a lender of last resort and all these things that banks take the benefit of, which is like a subsidy to your cost of capital, then of course you shouldn't be really setting up your own hedge funds and things and competing with hedge funds outside of banks with that subsidy in place. So it's quite clear that even for competitive level playing field reasons that shouldn't be really a part of banking. Let me say though that when it comes to things like special purpose vehicles and special purpose entities and the like, which are essentially just a hedge fund structure which can be on or off the balance sheet of a bank, if you're going to exclude private equity and you're going to exclude hedge funds, then it seems to me logically you have to start thinking about all those other special purpose entities which just look like a hedge fund, whether or not it's on the balance sheet of a bank or off the balance sheet of a bank. The other thing to think about in terms of the proprietary trading side is that actually, depending on exactly how you define this proprietary trading, is really going to define how draconian these measures are or are not. Because at the end of the day, what's in the customer interest, this is what we don't really have a clear picture on. But when you think about what's in the customer interest, any time a bank trades a position with a client of any form to make a profit for its own profit, how can that be in the client's interest? You know, there are things like underwriting, there are things like market making prices and so on, which are not trading against the client. But any proprietary trading of your own capital, hopefully to make a profit, is going to be, if things go right, by someone making a loss. Now, if you start thinking of it in those terms, what proprietary trading operations means could actually be quite general, and therefore it would be taking out a key cog in the mechanism of all this structured product businesses, all the proprietary trading desks and the like, which are very heavy in their use of derivatives. And as I said, those derivatives and their exposure to them was what caused contagion risk between these investment banking trading parts of the business and standard commercial banking, and which also meant that they were heavily exposed when institutions like AIG and Lehman Brothers failed to counterparty risk. So by basically looking to limit those activities to things which are just market making, underwriting and the like, which are for clients, but excluding all else, it would actually take down the exposure to those instruments, and that would be, it seems to us, to be quite a sensible step forward. Now, does this mean that banks can't do those things? Well, no, it doesn't. It doesn't mean that at all. One way to think about these things is that banks would be forced to sell off those proposed groups like hedge funds, private equity, proprietary trading, position-taking parts of the bank. But in fact, you don't have to do that, and the OECD proposal is a smoother way to do it, which is essentially to have firewalls between the capital used by those different groups, very clear, strong firewalls, so you don't have to break up the bank. Those activities still happen. We just firewall the capital and make sure that when people are raising capital to do those propositions, that they pay the true cost of capital, and markets are very, very clear about how much capital would be available in the event of problems that would not be able to spill over in terms of contagion and other forms of risk into the commercial banking part of the business model. Now, just let me turn to the second aspect of this: the limiting the size of the banks to. Now, remember that the US already did have this in place in terms of deposits. That banks shouldn't be able to own more than 10% of the deposit. Any one bank shouldn't own more than 10% of the deposits, and the proposal is just to apply this to the general balance sheet of assets and liabilities, so that you can't get around this by raising other forms of deposits. This too is actually quite a sensible move, because what it means is that it stops banks putting these hedge funds and special purpose entities into their mix that would push them up to be a very large size, and the whole too big to fail issue is there. But secondly, to the extent that it pushes funding into the shadow banking system, this may not necessarily be a problem. Again, it just basically means that more shadow banking, a shadow financial firm will start up to do these high-risk trades, which is where they'll be. But the key point is they will not be being cross-subsidised by a bank, and therefore their ability to grow in size will be less. They'll be paying the true cost of capital, not the cross-subsidised cost of capital, and it's appropriate that those high-risk activities happen outside the banking system. Now, should those institutions start doing commercial banking activities so that we try to bypass the whole regulatory net, then of course the regulators would have to make sure of what exactly a commercial banking means and have to bring those institutions back inside the regulatory net. So I think there are our main conclusions on the two proposals. Thank you.